Hello and welcome back to another episode of Darwin Investors. Man, I was actually going to take this week off from making videos, but this is going to be such a wild week on the market with the CPI read coming out and the massive short positions that are going on. I'm like, how can I not make a video this week? So we're going to dive into the inflation read, what the impact I think it's going to have on the market, given the numbers that are expected to come out, and then the way that a lot of hedge funds are positioned. And then after that, we're going to look at some of the bigger bears on the market, like how are they positioned, and what are the things that they're suggesting that you might buy. And last but not least, of earnings this week, there's not much coming out. Only Adobe is reporting this week that actually interests me. And so I'm going to show you how I'm going to be positioned to try and make a little bit of money out of Adobe. So let's go ahead and get into this. But before we get started, first I'm going to have to give you a word from my sponsor this week. Guys, do you sometimes have trouble saying all the wrong things? No worries. Have I ever got the product for you? It's my sponsor this week, which is beer. And this week I've got a pumpkin ale. Can't say that I've had too many of these, but we'll go ahead and give it a whirl because it's like all over the stores here and see what we think. Well, first of all, it smells like a cinnamon roll. That's weird. Why? Hold on a minute. I just brushed my teeth. Maybe that's the reason why it tastes so bad. We'll go. Now that the initial shock is over, we'll try it. Yeah, I don't like that at all. All right, let's go ahead and get started. All right, well, business before pleasure, I guess. So let me go ahead and first get this out of the way. Disgusting. So they finally released their inflation expectations, and it looks like we're expecting an 8.1% increase year over year, which is down from last month of 8.5% and way down from a couple months ago of 9.1%. So I would expect that the market's going to react very favorably to this inflation data. And that might explain why the market went up on Friday and again on Thursday, because a lot of market makers are expecting this. Now, how are they getting this information? Well, if you remember from the video that I made last week, if you watched it, it's very flat through here and it's very flat through there. And the way that they get inflation data year over year, and this would be a 1 year. I just hit the 1 year mark on the consumer price index from the Federal Reserve, the St. Louis Federal Reserve, and they give you all these charts. And what they're doing is they just divide this number by the number a year ago. Now they're expecting this number to be zero, so we'll go ahead and just use the number that they've given us here, 295.271. And you divide that by the number that we're expecting this, by the number that was last year in August, and that would be 273.092. And you're going to get the 8.1 that they're talking about. Now, there seems to be some sort of inflation revision downward between last week and this week, because last week was 296 and change, and this week is 295. So they will happen from time to time. They will have revisions downward, and that seems to be what happened. But if you divide this number by that number, and this number stays flat, you're going to get 8.1%. So I do expect the market is going to react pretty favorably to this. And one of the things that the market seems to know is that this is flat and this is flat. But say between October and June, this is very, very steep, especially if you consider that over time, like let's look over 10 years, it's not unusual for these things to come down. You know, it happens all the time. So there is precedent out there that this curve here could actually come down. And in order for the Fed to get their 2% inflation that they're looking for, let's call it 2.5%. All they have to do is take it right here where it went really steep and take this number here, this 295.329, 295.329 and multiply that by 1.0, and let's call it 2.5% inflation. And so that number would have to be 302.71, and that would give us a 2.5% inflation year over year as of June of 2023. Now, that doesn't mean that the prices of goods are going to come all the way back down to where they were, say, 3 years ago or anything like that. It just means that relative to this year, inflation has only gone up 2.5%. Now, how realistic is 302? Well, like I demonstrated before, it isn't unusual for stuff to actually come down. It's not unusual for this line to come down. And so the 7 points would be the line between here and here. Do I think it's achievable? Sure. Would I expect it? Not really. But do I expect that the number is going to come way down somewhere in the vicinity of 4 or possibly even a little bit less? Yes. Does that mean that the Fed might not tighten as much? I do believe that a pivot in the market now doesn't necessarily mean that the Fed is going to send interest rates down. It just means it just means that the interest rates aren't going to go up any further. And so I would expect in the long run, 2023 might end up being a really good year as the Fed tends to soften its stance as a result of lowering inflation, because that's what seems to be what this seems to be all about. And so, like I said, the forecasts are optimistic on the incoming CPI inflation report. And the reason for that is because stuff just keeps on falling in price. Shipping rates are falling. Is there anybody out here that doesn't think we can't go out on Black Friday and get a good deal on consumer durables like a laptop computer or a smart TV or maybe a pair of jeans or something like that? We all know we're about to get a bunch of good deals because the inventory is sky high. We also know that the cost of houses are coming down and the cost of automobiles are coming down. I mean, things are coming down. And so that's the reason why I think the sentiment is out there that inflation has peaked and it's coming back down. And that should send the market upward, as the Fed is not going to have to tighten as much. And as far as gasoline prices are concerned, it seems like the entire commodity complex is dependent upon the price of gasoline, be it shipping or be it even like wheat, because it takes gasoline or diesel to fuel those machines that are going to do the harvesting. And so U.S. gasoline prices are expected to keep falling as refiners keep making other products. And this is as of 3 days ago. And we'll see that wholesale gasoline prices are expected to keep falling in coming months as U.S. refiners overproduce fuel to try to rebuild low stocks of diesel and heating oil. And yes, I'm too cheap to actually subscribe to this, so that's all we got for that there article. And then after they release the data on Tuesday, there are other things that are coming out this week, and there are going to be other market catalysts out there. Some obvious, some not so obvious. One that would be obvious would be the Producer Price Index. It comes out the day after CPI. CPI comes out on September 13th at 8:30 a.m. And then the day after, on the 14th of September, we're going to get the Producer Price Index, and I would expect that that's going to be very positive. And the reason it's going to be positive, again, is going to be because of the price of gasoline, which has been coming down dramatically over the past 3 months or so. And then after that, now this might be viewed by some as bad data, but by this time, it may not matter. And the reason why is the unemployment rate for the month is going to come out on September 16th. And as we know, we're living in this bizarre world where we want the unemployment rate to go up. I'm not sure it goes up that much, maybe a little bit, I don't know. But in either case, we may be in a position where no matter what this number is, the market has to unwind and actually send it up. Because what's happening is that this chart here is a very important chart. The lower blue line, the more hedge funds are spending on puts. People are shorting this market at a rate way higher than ever shorted before. This even looks like a typo. So institutions bought a record amount in hedges. Here is the great financial crisis in 2008. This is how many puts were bought way back then. Look at us now. These option contracts are out of control. And this is not retail shorting. This is not like us saying, oh, okay, we're going to short this thing. This is big hedge funds and banks shorting this thing to this limit. Look at the difference between here and here. So these shorts have to unwind, and that might explain a little bit of the upward momentum that we saw in the market like later in the week last week, as people were already predicting that the forecast on inflation was going to be really good. So they're like, you know what, we got to get out of these short positions and now. So they started last week. It could be that it's going to go into this week. You could see the market take a really heavy hit downward as they try and push this downward and push it so that they can unwind of this stuff, because next Friday for them is going to be awful bloody if they don't actually do that. So I'm suggesting that if you have covered calls, or if you have something that that you might be a little bit down on, that like be a short position, and you see it briefly come up or get even, at the beginning of next week might be a really good time to try and get out of those positions, because that's what these guys are going to try to do. Because on Tuesday, I do expect this market to go up. And then, of course, by Friday, we're going to have like our monthly options expirations are actually going to expire. So let me show you what I mean by that. So here we have Advanced Auto Parts. And you can see that this company does monthly expirations. And the monthly expiration on options for a company that does something like this is this Friday. So all of these shorts are going to have to unwind by Friday, a lot of them anyway. And so that's different from, say, Apple. Apple has weekly options contracts. So you see that they expired last Friday, next Friday, then Friday after that. But a lot don't. A lot actually only monthly. And a lot of these hedge funds usually only sometimes close out positions and stuff on a monthly basis. So because of the way that hedge funds are positioned, and because this week's inflation data is supposed to come out pretty nice, and because this is the week that a lot of options contracts expire for this month, I expect that this is going to be an incredibly volatile week in the market. I mean, we might have days that you're going to see they're going to be down like 200 points or 500 points or whatever, only to finish up 300 or 400 points. I encourage you not to sell your stock and stuff like that when it goes way down. Of course, if you're watching this channel, you'll probably smart enough not to do that anyway. But what I'm saying is that don't panic this week, because it's going to be incredibly volatile. Now, if you're in the camp of, say, the bears, and you're thinking that the stuff really is going to hit the fan and that we are in a recession or going in a recession, or however you want to define this, and the S&P 500 is going to plunge 15% to 25%, which in the next 4 months, like our friend Mike Wilson at Morgan Stanley thinks. He put this out on Friday. He's known as the biggest bear on Wall Street, or at least he was until Savita Subramanian took his crown here. She predicted a floor of 3,200, and that was on June 3rd. She turned out to be dreadfully wrong, and did so very publicly, and decided to revise her actual prediction. Should we say she slashed her S&P price target to 3,600, and this was like a month and a half later after she was clearly incorrect. But she says, I'm going to slash it down to 3,600. Well, you were already at 3,200. So then, not to be outdone, Mike Wilson here, he says, okay, well, you're at 3,600, Savita. I'm the biggest bear in Wall Street. So he expects the S&P 500 to fall to 3,400 by year end. And take that, Savita. And what does he think that you should be investing in? Well, he says, go out and let's buy Eli Lilly. Okay, and he says, let's buy this well tower, which is a real estate business, and let's buy Exxon Mobil. So if we look at Eli Lilly, we're looking at a company that is trading here at an all-time high. It's also not particularly cheap, trading at 50 times earnings, and it pays a very rotten dividend of 1.23%. This to me is a sort of company that I personally wouldn't be getting into on these levels, because one, of valuation, and two, is because the dividend yield is awful. And so why would I get into that one? Welltower here seems to be a little bit more promising. Welltower does trade really richly and it has a nice dividend yield. The one thing I like about Welltower is it does seem to trade in a range. It's only up 4% over the past 5 years. However, it does seem to trade between where it's trading now and about 90 bucks. So I can see where this one would go up, except for the PE ratio is miserable. Let's see what Charles Schwab has to say about Welltower. I'm pretty sure it's not that great. Let me see here. Yeah, they give it a D rating. They give it a let's see, the price to earnings ratio is 142, forward PE of 106. It must have some really good growth, but the dividend yield is really good. And yeah, the growth forecast is decent. I think what we're trading on right here is this dividend yield and the fact that it's trading in the lower range of what is a pretty reliable stock that goes between 75 and $90. I think that's what Mike Wilson might be banking on. I do think that it's ironic that it's these same exact people that are telling you to buy Welltower at 106 times forward PE and Eli Lilly at 50 times are telling you don't buy Nvidia because it's overpriced at 40 times. It is very strange. Just manage your own money, people. Do what you want. The truth of the matter is, if you buy a great company and the stock market goes up, your stock will go up. And if you buy a great company and the stock market goes down, there's a great chance your stock will go down. And it doesn't matter what company you buy. But that's my 2 cents. And then the last one he looked at was on this article was Exxon Mobil. Now, I caution people of these energy stocks, and because they've made such a big run, but not only have they made a big run, I'm really leery of the way that the oil stocks are running with respect to how the actual price of oil is running. So if we compare Exxon Mobil here to crude oil, you can see the yellow line here is crude, which has come way down, but the stocks don't go down. If we add the comparison, say, of ConocoPhillips, you can see that Conoco is up 94% year over year, clear up here, and oil is clear down here. If we add, say, just really any of them, let's just add, what's the Occidental? That's the one that not Charlie Munger, but Warren Buffett really likes. Oxy is up 146% clear up here, and oil is way down here. You get the point. These things aren't exactly tracking oil. However, what's happened is that these companies are really in favor with a lot of the big banks trying to hedge for the recession. They're a big favorite of these people right here saying we have to pile into oil. It's the only safe haven there is. But what we could find is that their oil could be running into troubles. And one of the problems that they have is that they released their earnings, their last earnings, in June of 2022. If you look at the price of oil in June of 2022, you're going to see that a crude oil price of roughly $105 a barrel. And it had been really good. Remember, it's over the whole quarter. And we could see that it was very elevated throughout the entire quarter. So when these guys give their past earnings, it's going to be outstanding. And when they give their earnings forecast, they're also expecting that the price of oil is going to remain elevated. And that hasn't been the case at all. So what that's going to do is that's going to impact, I'll say, Exxon's price to earnings ratio. And so right now it's sitting at a very nice 10.56. However, if their earnings go down, this number could go up. If this number goes up, then the share price of Exxon could potentially go down. Now, I'm not saying that's going to happen. And even at the price where it is here at 10.56, that's historically pretty high. But right now, oil and energy is in favor, so it deserves to be high, I guess. But if this number shoots up a lot higher because the earnings of the oil companies aren't as they forecast in their last earnings calls, this could have a negative impact on the oil stocks, and we might see them coming back down to a price that more closely mirrors the price of oil. Now, that's not to say that these guys, the companies that are doing this, haven't got better with their capital management, or maybe their CEOs are just better at navigating a poor economic conditions, or somehow trying to find a way to make money where there isn't money to be made. But same as we're doing here in the stock market. Like I'm way better now at stocks now that the market has come down rather than the days when you could just buy anything and it would go up. I'm far more savvy at being able to figure out ways to make money. And I'm sure these CEOs are figuring out ways to make money even if the market goes down for oil. So maybe this isn't going to have any impact at all, but my feeling is that this probably is going to come down at least some. So I would be very careful if you're trying to hide out in oil stocks. And last but not least, we're going to have a look at earnings this week. The only one that interests me, like I said before, was Adobe. They come out with earnings on Thursday, the 15th. If we look at this, if we look at Adobe, we can see that right here, a good place to sell a put that would be pretty safe is about $350. Let's see how much premium we can get for that. So if I come over here and I say ADBE, and I look like I want to sell a put on Adobe that expires this Friday, and I want a strike price of $350, I can make $141 on this deal. And that's going to be something that I'm very likely to do. Actually, I'm going to do it. So I'm going to try and get 120 bucks out of this deal. Maybe even closer to 140, because if they report on Thursday, this thing's going to have no time to expiration come Friday. And so that's going to be something that I'm going to be doing this week. Another thing I'm going to be keeping an eye on is my very own options that I have open right now. Right now, I have sold puts on Amazon. I have sold puts on UPS, Google, and I have a covered call on Lowe's. So let me just walk you through the logic of this real fast. If Amazon finishes below $124 by the 16th of September, I'm on the hook to buy 100 shares of Amazon. However, if it finishes above $124, someone has paid me $126.35 to hold this contract. If it finishes above this, I don't buy the shares, but I keep their money. The same can be said for UPS with a strike price of $190 and an expiration of the 16th of September, and Google, which is a company I'm incredibly bullish on. And that company, I wouldn't mind being given these shares at $107.75, but I don't think it's going to happen. And again, their expiration date is the 16th of September. The strike price is $107.75, and someone gave me $125.35 to hold this contract. And last on the list here, we've got Lowe's. I sold a covered call on Lowe's, and selling a covered call is shorting the market, right? So I'm saying that if Lowe's goes over $210 by the 16th of September, I will sell you my Lowe's shares for $210 a piece. I'll net $21,000. That's fine. I'll get that money back. However, if this company is at $216, I still have to sell them at $210 a share. And that's why this is considered shorting the market. Not shorting in the same way that those hedge funds were in that earlier graph, because those guys were actually buying puts, but shorting it in a way where I own the shares and I think that it's only going to go up so high. And if it goes higher, fine. I lose, you win. However, if this thing should dive down on Monday, or just like a really sharp dive down as the bears try and get out of these short positions they're in, and I do expect something like that to happen. If this goes way down, and this number right now, I'm currently down $64. If I can get this really close to zero, or hopefully up about $5 or so, I'm closing this position out, because I think as the week goes on, things are going to go up. Now I'm going to show you a quick video that is an interview with Amy Wu Silverman. She's really, really sharp. But what's going on right now is there's a lot of volatility in the market with respect to these options and closing options, and people being caught with their positions so far offsides that if anything happens that they're not expecting, it sends it straight up. And if it does as is expecting, it sends it straight down. So I had a video that I made a couple of weeks ago saying that I thought that the market would trade fairly sideways. And 2 weeks ago when I made that video, it was 4057 on the S&P, and right now it's 4067. So it is trading sideways, but not without dramatic downturns and dramatic upturns. And that has to do with closing out of short positions. So let's check out this video real quick, and it's going to be real fast, maybe 10-15 seconds, and just show you that how I believe that I might be on the right track.
Amy, one of the things I know you look at, a lot of options traders look at, is something called Skew, right? They look at the relative price of call options and similar downside or upside protection put options. Is there anything that we can glean right now for the price of options as to whether or not there is more demand for upside protection or downside protection?
Yeah, that is a really great question because skew is essentially, I would say, our barometer for demand for downside protection. And that metric on a historical basis, and this is for the S&P 500, is still relatively low on a 5-year basis. If you look at the SDEX and you look at that percentile, it's still quite low compared to history. Obviously, that encapsulates the time that we had the pandemic. And one reason for that, Dom, is unfortunately, hedges have actually not worked out this year. Part of that is, path dependency, and part of that is we did have this drawdown, but then we had this big mid-June rally. So if you actually look at what has worked out this year, it has been put selling. But of course, it's very difficult to tell investors to do something like that in an environment where we have aggressive rate hikes as well.
So there you have it. I really respect her opinion. She just is so smart and she seems to really know what's going on. And so for that reason, I'm very encouraged to see that she says that selling puts kind of is the way forward to go right now, at least with respect to trying to make money in the short run. All right, so if you got anything out of this video, yeah, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a great day. Bye.